Good morning and welcome to the XM.com weekly market update. And with me today, Peter Mcguire, the CEO of XM. Good morning, Peter.
Good morning, Andrew.
Welcome back.
Oh, lovely to see you.
Big few days.
Where do you start? I don't know.
Oh no, we could sit here for probably an hour, but we'll jump straight in. The Aussie market, we've had the inflation numbers last week, which are still quite high. The RBA has kept interest rates on hold, which was not surprising.
Yes.
Aussie dollar is under pressure.
Yeah.
Yeah, and the commentary out of the Reserve Bank is sort of probably sitting tight for at least the next few months.
Exactly. Well, there was up until probably Monday, there was a 25% probability of a rate cut by December, 25 basis points. But now that seems to have washed out, that evaporated, and they're now saying it's probably going to be second quarter. So, it's just a waiting game. But if you're looking at the Aussie and how it's performed since the start of the month, start of July that is, at nothing short of magnificent in the sense you've had that rally to the upside and then all of a sudden all the hot air jumped out of it and the best part of 3 cents was wiped out over a window of about 2.5 weeks.
Yeah, the currency traders will be not only liking this market, but plenty of other ones like the yen. Incredible.
Incredible. Up until about 11% move, and that was the other day, it was 11 or 12% move since the 11th of July. So when you're seeing that there, it's just showtime. That is just an enormous, just short that market, short US dollar or long yen, and it's just been dynamic.
Yeah, but considering the rate movement was 0.15.
Yeah, and the bond cutting back is nothing that tremendous.
No, but it's in the whole scheme of things, it's a tiny move. But is it like there's a lot of talk about the carry trade and the unwinding of the carry trade?
Absolutely.
Which I think it's the knock-on effect.
Leverage drives leverage.
It does, yeah. And once that starts to unwind,
you've got to liquidate positions if you're on the wrong side.
Yeah, it's a bit of a race for the exits.
Well, that's right. You've got to meet the market.
Yeah, for sure. The Nikkei.
Meet the market, they say.
Tell you what, so this is dropped, what was it, 12.5% a couple of days ago. It's recovered a fair chunk of that, but it's pretty much flat for the year now.
That's right. Yes, well, when you're looking at what it fell from that again early July, that I think it was about the 10th again, 42,000 points, hit 32. So it was just a massive fall and now it's bounced back to, nearly 35,000. But everyone knows the news. I can't add any more story other than wow.
Yeah. And a lot of it is probably an overreaction, but it just tells you how sort of jittery the markets are at the moment.
Yes, in a lot of ways, certainly, there's many analysts and pundits and traders are saying it's overheated. And, these sort of things, you can't deny the fact it was the largest fall since 87 for the Nikkei. And I don't know, what's around the corner. Is it a dead cat bounce? Is it going to continue an upward lift? Only time will tell. But it's a market that, you've got to watch because since the window of time when you're staying, that chart is since the start of the year, and around that 33, it's had an enormous rally over that period and then all of a sudden, bang.
Yeah, sure. The volatility, the VIX as well.
Yeah.
Now, once again, this is only a 5-day chart. So we saw the spike up only a couple of days ago and it's pretty much back to where it was.
That's right.
4 days ago.
Well, that's the S&P 500 options. That's what the VIX is. It's an index on those options. So it's the volatility of the option. And I'm speechless. The market just absolutely went ballistic. I think it went from about 24 to 65 or 66. And I couldn't believe it in that short, over about a 10-hour period. Yeah. Let's just see what happens. That's the volatility, all right.
That's for sure. Last week we got the non-farm payrolls, which was probably sort of the genesis of the unwinding of all this. It was a number which quite a lot lower than the market expected.
114,000 versus 175 analysts expected, or economists.
Yeah, and the unemployment rate went up a little bit as well.
Yes.
So that combined with a bit of uncertainty in the market, and obviously all the geopolitical issues that are raising its head at the moment.
Well, I've got to say, from a geopolitical standpoint, and we're on the cusp of World War III, everything you read and all the news, and I read global news. Oil hasn't bounced. No. Gold hasn't bounced. No. US dollar, really, the only currency that's moved has been the yen versus a number of everything else. The US dollar's suffered a little bit of softness. Japan's stock market capitulated, then bounced back. US markets, they're down and then they're up. There's no big geopolitical to say oil's now at $100.
No, that's right.
That's the point I'm trying to probably
it is
premise.
It's unusual behaviour from the markets in
Yes.
this environment, and like we're still in earnings season in the US, and it's been a reasonable earnings season.
Yes.
It hasn't been horrible at all.
No, I've got to agree with you there.
So it's it is odd compared to past decades.
Yeah, and especially as you mentioned first off, the conflict that seems to be mounting by the day from a war perspective, that hasn't rolled across to energy markets.
No.
Maybe that's the next one to bounce.
Next domino, yeah. And finally, obviously, these fixed income markets, huge movements there as well. So they've crept back up a little bit overnight, but there's pretty much that, they're saying 100%, 25 basis point cut in the US in September.
Well, they're saying now 50. Citibank are saying 50, and everyone... I was on the BBC the other day. They said, is it going to happen to be 50? Well, look, it's pretty hard to go against, 100 analysts at Citibank and Goldman's. They're saying it. And so if that was the case, Andrew, I'm sure that would impact the market to show that the fragility possibly of the US market. So we're in the hands of the Fed. But if they roll 50 out, then they're saying another 50 by the end of the year. Yeah. And you've got an election less than 3 months now.
Yeah, like in a way, if they did 0.5%, that will probably spook the market more.
Well, this is what I'm saying from a market sentiment perspective.
Yeah, unless they just hold fire and do 25, 25, 25 maybe just to play it out. So
yeah, well, they're saying it's 125 basis points worth of cuts, a 50 or 50, whatever way you dice and splice, but it's 125. So you've either got to roll it forward and go 50, 50, 25, or as you said, 25, and you've only got so many months. I don't think there's one in November because of the election, and I'm not sure if the Fed's meeting in October because of the election.
Oh, right.
And then it can be considered.
Okay.
If I'm sitting here and I'm an Australian citizen, but I've got to say, political interference, and you roll a big rate cut in before the election to swing voters, that's how it can be interpreted also.
Yeah, it can be, but I think if the markets are that jittery, then they'll have to do it. So
that's right, yes.
Yeah. So plenty going on. The Bank of England dropped rates as well.
Yes.
So that's another domino to fall there. So
I don't want to see if the ECB does anything because there's every chance they're going to have to cut rates again in September as well for growth.
Yeah, all happening.
Wow, what a week. I've missed you, I missed this. And, we talk and for the viewers out there, what do you want them to just study? What would you say to study over the next week? What's the best?
I don't even study. You don't study anything.
Just sit and watch.
Stay alert.
Stay alert, sit and watch.
For sure.
Look at your bond market. I mean, you've got to look at that. And you've got to look at your currencies naturally and central banks. And then keep a close eye on, I suppose, equity markets and commodities.
I think so. And I think sort of like talk of recession in the US and all that sort of stuff, that is so overblown at the moment. The economy is still very strong. So, you're going to be able to pick up some bargains. There's some really high quality US stocks, which some of them are trading down between 20 and 30% from their 52-week highs. So,
in what period? The last month?
No. A lot of
the last month they've
but they've come off quite a bit as well in the last. Some of them have, like those consumer, like the McDonald's and your Starbucks, things like that. They've come off quite a bit in the last sort of 3 to 6 months. So there's some really high quality companies there which are off quite a bit, which you would sort of think they sort of. Well, they're not going to go anywhere.
Well, they're not going to close business.
No, of course not.
I think people are going to still buy coffee and burgers.
Yeah, so they're all going to be around in 10, 20 years' time. So, but I think, go bargain hunting maybe. Anyway, okay. We'll keep an eye on it and have another chat next week.
Look forward to it.
Great, thanks, Pete.
See you, Andrew.
And that's the XM.com weekly market update.